demonstrate the features of the software, different plans are used to explore the relationships between the budget, transaction account and the investment plan. The Chevron Planner page is divided into personal cash flow and investment assets and loans. Note that the home and superannuation are treated as investments. The home is a store of wealth which can be used to fund the retirement by downsizing. It can also be used as security for investments. It is this page where you will do your plan construction. The budget is the account through which all personal income and expenses transact. All calculations in the budget are in present value. This includes the values of loans, which can be quite confusing for some people when you see that the loan balance is discounted for inflation. Income may be salary, which includes income from other sources, such as income from a business that you may own or a family trust. In the retirement phase, the user nominates the required income. This income is derived from the retirement accounts and investments. The user can nominate for each account when and for how long they want to draw down that account. This money is deposited into the transaction account at the start of the year. Also at the start of the year, the nominated retirement income is withdrawn from the transaction account and deposited into the budget. The retirement income is allocated into three types: drawdown from retirement accounts, drawdown from investment income, and drawdown from investment capital. Having this division of the retirement income allows you to see where the money is coming from in retirement. Particular attention should be paid to the amount of investment capital spent in the initial stages of retirement. The more capital spent, the less money you have for future income. This means the length of time your funds will last will be shorter. There may be times when money needs to be transferred from the investment part of the plan to the personal part of the plan. This can be done through the transaction account. These are some examples as to why you may want to transfer the funds. Rather than saving for lifestyle goals such as a car, boat or caravan, you may choose to include those savings on the investment side where the income from the savings is calculated and taxed. The lifestyle goals do not earn income or pay tax while the funds are being held in that account. There may be times when you need to supplement your personal income prior to retirement age. For example, you may own a rental property and wish to use part of that income for living expenses. In the retirement phase, income may also come from what we call pensions from external sources. This is different from the retirement accounts, which are superannuation, self-managed superannuation, and annuities. This income flows directly from the pension account to the budget. There are two types of pensions. The first is a non-means tested pension. In this example, both partners have nominated they will receive a pension of $10,000 each year from age 75. The means-tested pension defaults to the values for the Australian age pension. However, these values can be edited, so you may use the pension for someone, say, on a disability pension. Access is not restricted to after the nominated retirement age. This means it can be used for people on disability pensions, however the thresholds would need to be changed. In this example, the user is eligible for a part pension under the assessment of both the asset and income test. The program selects the correct value. In the tax estimator, the tax due is calculated and proportionally allocated to the transaction account for investment income and to the budget for personal income. The tax estimator is located on the Chevron reports. Where you have HEX debt, the current loan details can be entered in the tax schedule. The repayment amount is calculated according to the current HEX help table. Where applicable, this value is automatically added to the tax estimator as a separate line item and to the budget as part of the tax due. The tax scheduler is accessed on the planner page at the bottom of the column Calcs and Settings. Personal loan expenses are divided into personal loans and credit card debt. Personal loans may be any of the following: interest only, principal and interest, interest only followed by principal and interest. The interest rate may be fixed or variable, and loan costs may also be included. The credit card account is intended for the purpose of repaying your current balances not paid at the end of the month. It is intended to set up a schedule of payments to repay that debt. There are a number of options to design a suitable debt management plan. In the first example, a monthly payment of $200 a month is allocated. In the second, the payment is 2.5% of the debt and an additional $100 a month starting in month 6. Note there is a minimum payment of $200 a month, so that if the combination of the percentage and the dollar value does not meet the minimum monthly payment, the minimum monthly payment is selected. By far the quickest data entry for living expenses is in the starting position. While entries can be entered directly into the plan, the process is a little more time consuming. The program is designed to be quick and efficient. Note that you can remove and retrieve items by unchecking the active box. By ticking the optional box, the program identifies and calculates the values of items which are optional. The reason is that you may need to explore cash flows should you be unable to work. Optional living expenses are excluded from the cash flows in the insurance needs evaluation, as you may have to limit those optional expenses if you have no income. If you have excessive debt which requires you to create a debt management plan, the program will demonstrate how debt can be reduced. That is by applying a nominated percentage of optional living expenses to the loan payments. When the entry is entered in year 1, the values will auto-fill to the end of the plan, but can be changed in any year, in which case the new value is auto-filled from that year to the end of the plan. If you want to have an expense for just 1 year, then you would enter the value for that year and in the following year enter 0. The 0 is auto-filled for the remainder of the plan. A review of the budget at the start of the retirement phase is wise. You can change the value and remove expenses in any year. While you can view the detailed entries under each of the 10 tabs, the total amount for each category is included in the top section of the budget. Lifestyle goals are a savings plan for the purchase of major personal expenses such as saving for a car or a holiday. Using this account, you can save for personal items which may save you having debt when you want to purchase them. The items are displayed in the budget. When allocating the cost of insurance premiums, they have to be allocated to either superannuation or the budget. Sometimes you may not want to assign to either category. Note that while you can enter the cost of superannuation, the values are not transferred to the superannuation account. All superannuation insurance costs must be allocated within the nominated account. If the cost is allocated to the budget, you can nominate if the expense is tax deductible. When allocating how much each policy should be, don't forget to check if you will have to pay tax on the payout amount. Note that you are required to enter an age range for each policy. This will allow you to increase values as you get older. You can do one of the following: keep the value of the policy the same and increase the cost. Keep the costs the same and reduce the value of the policy. Note that only the income insurance in this example is added to budget expenses. It is important to understand that unallocated funds are not transferred to next year's calculations. It is assumed that this income will be spent at some time during the year. Having a very tight budget may set you up for failure, so leaving some money on the table for unexpected expenses may make you feel more comfortable. While there may be great value in creating a budget, there may be times when you just want to allocate one value which would be entered in, say, commitments. The other option is to not allocate any living expenses. Then the value of the unallocated funds is how much you will have to spend on personal expenses. In this example, we have allocated one big expense of $120,000 in year 3 to demonstrate the view when the user does not have sufficient funds. In this case, the item is listed as a negative red value and the word overdraft, highlighted, is listed under. It is important that you have sufficient funds for that large expense, say something like a big holiday. You could design a method of saving for that expense prior to the date by using the lifestyle goals option. The other option is to fund the expense with a loan. The investment plan is where the savings allocated from the salary is dispersed directly to the accounts. The allocation may be to loan expenses. These are home loan, investment property loans net of rent, share portfolio loan. Investment assets, which include cash, term deposits, bonds, shares and managed funds. Personal contributions to superannuation include both pre- and after-tax contributions. The loan expenses are automatically calculated and transferred to the transaction account for payment of loans. Any funds not allocated are also transferred to the transaction account. Before we look at the allocation of salary to savings, let's look at some of the options that are available in the salary account. Firstly, the method of salary increase defaults to inflation, but you could also nominate a specified increase or no increase. The program defaults to employer contributions activated in the salary account. Some people have different percentage of employer contributions from that regulated by the government. Take note of the activation boxes. You will find these throughout the software. By unchecking the box, the calculation is removed, but reappears as soon as the entry is re-ticked. This saves double entry of information. In this example, John wants to include income from a family trust, which does not require the automatic allocation of employer contributions. In the second screenshot, the trust income has been deactivated but can be reintroduced into the plan at any time. If you are using the importation of data from the starting position, you will have just one value for the nominated number of years, in this case 15 years. However, if you are likely to have a salary increase due to a rise in work responsibilities, these can be entered. For example, you may expect to rise from regional manager to state manager in 5 years' time. Note that all values are entered in present value and are increased according to the method of increase selected. It may be that you plan to take a gap year or work part-time, and this information can also be entered. Note that you can use the tick box to deactivate the percentage of salary to be allocated to investments. In the starting position, after all the entries have been made, you can allocate the monthly value of funds to be allocated to additional loan payments and other investments. The program calculates the amount allocated to loan expenses less rent and the additional loan expenses together with allocation of investments to allocate a percentage of salary. This percentage is transferred to each of the salary accounts listed in the starting position. In this example, the percentage is 14%. Once you commence the plan, you can now change the allocations for future years. In Salary B, the percentage has been increased to 20% for the last 10 years. However, in year 6, there is no salary, so the allocation will be 0 for that year. To the right of each salary is a graph which combines all salaries from both partners. This is presented in both future value, blue, and present value, pink. Note that this colour scheme is maintained in all graphs showing future values and present values. The grey columns are the value of savings allocated from the salary in future value. In this example, the plan is a 30-year plan with 15 years in the savings phase and 15 years in the retirement phase. One can continue to have salary income in the retirement phase. All income listed in the salary is taxed according to the income tax schedule. The program defaults to a progressive tax rate for Australia plus an additional 2% for Medicare. This is not prorated for low income earners. When the tax schedule changes, check that you have the latest version for the plans you're working on. This should default to the most recent version for new plans. Old tax schedules are maintained and you can elect to use these by clicking the drop-down list. You can also edit the schedule. Using the investment plan is the most efficient way to distribute your salary from savings. Keep in mind we are talking about dynamic cash flow modelling. Everything needs to be quick, and if you change one thing, the software should be able to automatically update all calculations. This is best done by allocating by percentages. Thus, if you change the loan details, the balance of the funds to be distributed are automatically updated and calculated. If you're starting a plan, you should add all the new accounts you plan to use. After the accounts have been created, they will appear and automatically ticked for allocation of funds from the investment plan. Note that the software defaults to not including superannuation funds. However, you can activate any of these accounts if you wish to make an allocation. Likewise, other accounts which are not used for the distribution of funds can be deactivated. For each 5-year period, the allocation autofills to the end of the row, but you can change the autofilling as shown in Partner A Super. On the Chevron report, the plan outcomes has a copy of a graph as part of the key indicator graphs at the top of the page. This is also included on the review Chevron. This is intended to alert you if you've forgotten to add your salary or allocate savings from salary. Here's a tip for reading graphs. By clicking on the 3 bars above the right top-hand corner, you can download the graph in a number of file formats. You can also zoom a portion of the graph by placing the mouse at the start of the required zoom and drag the mouse to the right. The data table takes you through the process of how the funds are allocated. The first row lists the salary allocation to investments. Note that investments include home ownership and superannuation. The second row lists the allocation to home and net asset loan costs. These funds are transferred to the transaction account to pay for these costs. In the section Usage of Remaining Funds, the following are listed: remaining investable funds, funds moved to the transaction account, percentage invested in other assets, 70%. The program assumes that this allocation is made on a monthly basis throughout the year. Thus, the allocation is found in the section Balance at Start of Year after annual transactions. The income calculated is averaged over the 12-month period. Thus, the calculation for the first year of the deposit is 50% of the annual rate. This is the entry in the transaction account. This is an example of funds allocated to the share account and are deposited directly into the share portfolio. Note the buying costs have been deducted from the allocation. Sometimes you may want to allocate specific dollar values rather than a percentage of your salary savings. This is most likely to be the case when allocating, say, $5,000 to personal after-tax contributions. This can be done by going to the superannuation account and nominating a schedule of contributions. In this example, you would use part of the 30% of savings from salary deposited into the transaction account. However, you need to check that you do have funds available for this allocation. If something else changes in the plan, say you want a $50,000 deposit to purchase a new home, the transaction account may no longer have funds available. In the other accounts, there is an area where you can make direct deposits from the transaction account. In this example, the user has elected to deposit $5,000 a year into the emergency cash account for 5 years. Again, you would need to check at the end of your plan creation that you do have the funds in the transaction account and that the account is not overdrawn. Note that the $5,000 is indexed each year at the rate of inflation. Let me remind you about why we should try to use percentages rather than dollar values. Financial Mappers is dynamic cash flow modelling software. Every time you change an aspect of the plan, all accounts affected by the change are recalculated. For example, you may start building your plan with the aim of purchasing an investment property in year 5. You later think of a better strategy and change the date of that purchase. The The change in the loan expenses for that purchase will impact on how much money is allocated from the salary savings. If you use the investment plan, then the values are automatically calculated because you are using percentages. Where you had elected to use dollar values, you would need to check that you still have adequate funds in the transaction account to make that deposit. That said, there will be times when you do want to use dollar values, and this has been catered for. You just need to carefully review the plan at the end to ensure that your transaction account is not overdrawn. The transaction account is the account through which all your transactions for the investment assets and loans are managed. The exception is the salary savings allocated to specific assets, excluding loans. Please note, sometimes in the software, the transaction account is referred to as the bank account. This is because the line spacing in some instances does not provide for the words transaction account. In the original design, the account was called the bank account, but later renamed to improve clarity. The transaction account is the account through which tax due on investments is paid at the end of the year in which the tax liability or the tax credit occurs. Because this software is dynamic, the transaction account will continue to display the results when the fund is overdrawn beyond the overdraft limit. A small graph at the top of the account monitors this problem. There is a red bar which displays the value of the overdraft. You can configure this account as you want. These are the items you can configure. Balance at start of plan. Note that you may have just one account for all expenses, personal and investment. While you don't physically need to do this, you do need to be aware that the account only shows transactions for the investment side of things and the personal transactions are in the budget. Overdraft limit and overdraft interest rate. If you set an overdraft limit and the account is overdrawn within that limit, then the result will be displayed as a negative number. In the row, balance after transactions at start of year, any negative values which exceed the indexed overdraft limit will be highlighted. It is recommended you do not use the transaction account as a form of investment loan. It is much better to create a loan and allocate the loan to its correct purpose. That way the software can correctly calculate statistics. The overdraft should only be used for short-term cash flow problems. Its primary purpose is to ensure that the dynamic nature of the software works. However, a plan is of no use if at the end of the plan you find you have $1 million overdraft that you cannot repay. This is a note on calculation of interest on overdraft. The program calculates the interest charged on the overdraft as the balance after transactions at the start of the year. It may be that you have regular monthly income which will negate some of this cost, thus there may be inaccuracies. This problem is magnified if you accidentally don't have sufficient funds in the transaction account. For this reason, you may be better to leave the overdraft rate at 0%. If you plan to run an overdraft, you just need to monitor the account carefully. Is interest tax deductible? The program gives you the option to include a tax-deductible interest rate. However, you need to ensure that the transaction account is not accidentally overdrawn, as the tax estimator will calculate interest due and include that value as a tax deduction. Minimum balance for payment of interest. For ease of plan construction, you may prefer to keep the transaction account as the major account to hold all cash-type assets or as a cash management account. In this case, you may want to include a minimum balance before interest is calculated. This will increase the accuracy of your calculations. However, the small amount of interest, say 0.01%, often given on low balance accounts, will not be included in the calculations. Rate of return. You will notice in this example the specified rate is listed, although the value of the default rate is displayed. The reason is, in this example, the interest rate was imported from the starting position. Any interest rates for either investment returns or interest charges on loans are always listed as specified when imported from the starting position. Normally, when you create an account, this rate of return is the default rate. Because default rates are based on long-term rates, this percentage is considerably higher than rates achievable in the current economic circumstances. You may prefer to use a lower rate for this account and other interest-earning accounts. Fixed or variable rates. The program defaults to a fixed rate. This means that if the income modulator is activated with a change of rates for cash-type assets, the rate will not change in the transaction account. Method of calculating costs. The account defaults to the option None. However, you can choose a fixed dollar value. This expense is included in the withdrawals paid monthly. One-off receipts allow the introduction of funds to the plan which are not taxed. Examples may be an allowance for a future inheritance, an allowance for income from a hobby which is not to be taxed. As mentioned in the budget section, one-off withdrawals allow the transfer of funds from the transaction account to the budget income. One-off expenses can be used for expenses to be withdrawn from the transaction account. If the expense is tax deductible, you can identify which partner is to pay the tax. You may want to include items like your accountant's fees, which are tax deductible. There may also be times when you want to include some personal expenses which are not regular payments and you do not want to include in the budget. The methodology of the transactions is the same for all accounts. In general, assets are purchased at the start of year, assets are sold at the end of the year. Income and expenses which are paid monthly are calculated as the average for the first year. The top section shows the start of year balance. This is the balance before any transactions are considered for the nominated year. A new balance after transactions at start of year is then calculated. This is the figure on which income and costs calculated as a percentage are calculated. This is followed by monthly transactions and then transactions at the end of the year. Net monthly cash flows are also displayed. Tax due on investments and capital gains tax are deducted at the end of the year in which the tax is due. Default rates are intended to speed up the planning process. This is because you don't have to enter this information every time you start a new account or loan. However, when you don't want to use that default rate, it is easy to select the specified rate and make the entry. In Financial Mappers Pro, the default rates are set by the administrator and cannot be changed by the user. If you are a Pro Connect client, then you should consult the default rates on your platform. If the administrator should change the default rates, which may happen as the economy affects interest rates on loans and investment terms, the rates will change in your account for future plans. If you click on the icon Plan Default Rates, you can view the default rates which were used for the plan currently being displayed. If you have purchased a personal copy of Financial Mappers, then you can nominate the default rates. If you are making a plan for very long term, say 30 to 50 years, then using long-term averages makes sense. In Financial Mappers, a version for single use or do-it-yourself investors, the default rates have been set as the average for the 20-year period from the year 2000. ASIC requires that any calculations predicting retirement incomes must use an inflation rate of 2.5%. The inflation rate for that period was the same, 2.5%. Note that the same returns have been used for real estate and shares, with the average capital growth applied to both, that is, shares 5.47% and real estate 6.71%, to give an average rate of 6.12%. The reason is to ensure a bias is not displayed between the two asset classes. Over the very long term, the difference is unlikely to be great. With interest rates on loans, all loans have been benchmarked against the standard home loan rate. Interest-only loans have an additional margin of 0.5%. Note the heightened figures which have been changed from the actuals. If you are making a short or medium-term plan, then you may want to use a shorter time frame for your average rates. Listed below is the average rates over different time periods. These figures will be updated in March of the following year when we have all the data available. There are two ways you can change default rates. The first method is in the drop-down menu and it is called User Default Rates. It is here that you can change default rates for all future plans you create. The second method is to change the default rates in the plan you are currently using. Changing rates here will not affect any other plan. If you return to a plan which has different default rates to your current user default rates, you can check back to quickly see the rates, and if you want, you can change the rates just for that plan. There is more material in the PDF tutorial, including our section Doodle Pad. The software is designed to be educational and fun. Sometimes it's not about creating a very complex investment strategy. It can also be about understanding the basic cause and effect of financial decisions you make. We like to think you can use financial mappers as a doodle pad where you can look at very simple concepts. Then you can try to understand what is likely to make the outcome better or worse.